Welcome. Today we're getting into a really vital topic, and this discussion has been arranged for us by my tax accountant. They're a well-known firm here in the UK. We're looking at how you handle inheritance tax when assets are located outside the UK.
Yes, it's definitely something that can seem uh, quite daunting.
Absolutely. It feels complicated enough dealing with UK assets, let alone throwing overseas property or bank accounts into the mix. So our goal today is to, well, pull out the key bits of information you need.
Exactly. We want to make it clearer. Inheritance tax on its own is complex. Add in that international element, and yeah, it can feel overwhelming fast. We'll be drawing on the official gov.uk guidance, specifically the notes for the IHD 400 form, and also thinking about the kind of support firms like my tax accountant offer.
Great. So let's try and navigate this, avoid some common pitfalls maybe. Where do we start? I guess the absolute foundation is working out someone's domicile.
Precisely. Domicile is, well, it's fundamental. It's not just where you live. It's considered your permanent home, the place you have the strongest ties to, and crucially, where you intend to return eventually.
Okay, so intention matters, and it's not the same as just residency.
Not at all. And another key point for UK tax law, the UK isn't treated as one single place for domicile. You've got England and Wales together, then Scotland separately, and Northern Ireland separately again.
Right. And what about places like Jersey or the Isle of Man?
Good question. For domicile purposes, the Channel Islands and the Isle of Man are actually treated as foreign countries. They're outside the UK system in that sense.
Okay, that's important to know. But I've also heard about being deemed domiciled. How does that work?
Yes, deemed domicile is a really significant concept. Basically, even if your legal domicile, your domicile of origin perhaps, is outside the UK, you can be treated as domiciled here for inheritance tax if you lived in the UK for a long time.
How long are we talking?
The main rule now is if you've been UK resident for at least 15 out of the 20 tax years immediately before the tax year you die in. If that's the case, HMRC can deem you domiciled here.
I see. So even if someone always intended to return to, say, Italy, but lived and worked here for 18 years.
Their worldwide estate, including that Italian villa, perhaps could potentially be subject to UK inheritance tax. Just a small note. The rule was slightly different for deaths. Before April 6, 2017, it was 17 out of 20 years then.
Okay. So long-term UK residency is a major factor.
A major factor. And there are a few other wrinkles, like if you were domiciled in the UK under English law at any point within the 3 years before your death, that can also bring your worldwide assets into scope.
Wow. Okay. So recent history matters too.
It does. And you also have to consider double taxation treaties. Sometimes, under these international agreements, a person might actually be treated as having a domicile in both countries. The treaty then usually has tiebreaker rules to determine which country has the primary taxing rights.
That sounds like another layer of complexity.
It can be. It really highlights why establishing domicile correctly is the absolute first step. And things are changing slightly again soon.
Oh.
Yes, for deaths happening on or after April 6, 2025, there's a new concept of being a long-term UK resident. This applies if you've been resident here for at least 10 out of the last 20 tax years.
10 years. Okay. Less than the deemed domicile rule.
Yes. And if you meet that 10-year test and then leave the UK, you might still remain within the scope of UK inheritance tax for a certain period after becoming non-resident, potentially up to 10 years, depending on how long you were resident before leaving.
Right. So leaving the UK doesn't necessarily mean an immediate exit from the IHT net if you've been here long term.
Exactly. It's designed to cover people who might have built up significant assets while a UK resident.
Okay, so let's assume domicile or deemed domicile means overseas assets are potentially liable for UK inheritance tax. How do you actually go about reporting them? You mentioned the IHT 400 form.
Yes, the IHT 400 is the main inheritance tax account form. And there's a specific section, box 44, labeled foreign assets. That's where they need to be declared.
And what value do you use? Is it the value when the person bought it or?
No, crucially, it's the value at the date of death. And it has to be the open market value.
Open market value. What does that mean in practice?
It means the realistic price the asset could have been sold for on the open market at that specific time, the date of death. So it's not an insurance value, not what you hope it's worth, but what a willing buyer would realistically pay a willing seller.
Okay. So for a property abroad, you'd likely need a formal valuation from a local expert.
Almost certainly, yes. And for shares listed on a foreign stock exchange, you'd need the closing price on the date of death. Bank accounts are usually simpler, just the balance. But the key is you need evidence for that value.
And I assume you need to declare everything.
Absolutely. The executors or administrators have a duty to make full inquiries to identify all assets wherever they are in the world. Bank accounts, properties, shares, valuable items, anything.
And once you have that value, say in euros or dollars,
You then need to convert it into pounds sterling, GBP. You use the exchange rate applicable on the date of death. HMRC publishes official rates, or you can use rates from recognized financial institutions.
so find the asset, value it properly at the date of death, convert to GBP, and put it in box 44. Seems straightforward enough when you break it down, but I imagine getting those valuations can take time.
It definitely can. Contacting banks, valuers, or stockbrokers overseas often takes longer than dealing with UK institutions. It's something to factor into the administration timeline.
Right. Now, are there situations where overseas assets might be, well, excluded from UK IHT, even if the person was UK domiciled or deemed domiciled, or perhaps some reliefs available?
Yes, there are some important possibilities here, mainly around the concept of excluded property. This is particularly relevant if the deceased was not domiciled in the UK.
Okay, so this is more for non-dongs.
Primarily, yes. For example, foreign currency bank accounts held with certain UK banks might be treated as excluded property. For deaths up to April 5, 2025, this applies if the deceased was domiciled outside the UK and wasn't resident or ordinarily resident here.
And after that date,
For deaths on or after April 6, 2025, it applies if the deceased was not a long-term UK resident and not resident in the UK at death. If an account qualifies, you list it in box 52 of the IHT 400 and then deduct its value in box 92 so it doesn't get taxed.
okay. So a non-dom living abroad with, say, a US dollar account in London might escape UK IHT on that particular account.
Potentially, yes, under those specific conditions. Another area is certain UK government securities, sometimes called gilts. If they were issued under FOTRA conditions, that stands for free of tax to residents abroad, they might also be excluded property if the deceased owner was not resident in the UK.
Where do they go on the form?
Those would typically be listed in box 62 and again, the value deducted in box 92.
Are there any other reliefs? What about the standard ones, like transfers between spouses or gifts to charity? Do they work for overseas assets?
Generally, yes. The spouse or civil partner exemption, for instance, can apply to assets passed to a surviving spouse, regardless of where those assets are located. Same for the charity exemption.
But there might be catches.
Well, you just need to be careful. For example, the spouse exemption might be limited if the deceased was UK domiciled, but the surviving spouse is not. And for charities, you need to ensure the overseas charity meets the UK requirements to qualify for the exemption. So while the principle applies, the specific application needs checking.
It certainly sounds like getting professional advice is almost essential when overseas assets are involved.
I would strongly agree. The interaction between domicile rules, foreign legal systems, valuation requirements, double tax treaties, and potential exemptions, it gets very complex very quickly.
Mistakes could be costly, I imagine.
They could be, both in terms of potentially paying too much tax, or indeed not paying enough, and facing penalties from HMRC later on. Getting it right from the start is crucial.
Which brings us back to the kind of help available. Firms like my tax accountant, who arranged our chat today, specialize in this, don't they?
Yes, absolutely. Dealing with cross-border estates is a specialist area. An experienced advisor can help determine domicile accurately, ensure all overseas assets are identified and valued correctly according to HMRC rules, calculate the tax properly, claim any available reliefs or treaty benefits, and handle the IHT 400 reporting.
So they can basically manage that whole complex process.
They can guide the executors through it, yes. From understanding the initial position, gathering the information, completing the forms, dealing with HMRC queries, and even advising on potential planning strategies, if that's relevant earlier on. It's about having that expert partner to navigate the global aspects of the estate.
It sounds like invaluable support when you're already dealing with a difficult time.
It really can be. It removes a huge amount of stress and uncertainty.
So just to recap the main takeaways then. First, domicile is absolutely key. It determines whether worldwide assets are even in scope for UK IHT. And remember, deemed domicile for long-term residents.
Correct. Second, if overseas assets are in scope, they must be valued accurately at the date of death, converted to GBP, and reported on the IHT 400 form.
Right. And third, while standard release might apply, there are also specific rules around excluded property, particularly for non-domiciled individuals, which could exempt certain foreign assets.
Exactly. And always consider double taxation treaties if another country might also have a claim.
It's definitely intricate. The rules depend so much on individual circumstances, domicile, residency, where the assets are, treaties.
Which is why, as we've said, getting personalized advice is so important.
Absolutely. So if you're listening and facing this situation, or perhaps helping someone who is, we'd certainly suggest reaching out for professional guidance. My tax accountant, who kindly arranged this discussion, have deep expertise in handling UK inheritance tax involving overseas assets.
They can help simplify the process, ensure you're compliant, and ultimately provide peace of mind.
Definitely worth considering for securing that legacy properly. Thanks for breaking that down today.
My pleasure. It's an important area to understand.